Today on the Home Strategist, if you're a home buyer, you've probably heard the term debt ratio. Banks treat it like the law of gravity, but most home buyers have no idea what it actually is or why it doesn't tell the whole story. Let's break it down. I'm Dr. C, and you're watching the Home Strategist. All right, a debt ratio, or sometimes referred to as a DTI or debt to income, is how lenders decide if you can afford a mortgage. It compares a couple of different things. First, your monthly debt payments, and secondly, your monthly income. The result is a percentage. For example, and these are very simplistic numbers. Let's say that you make $6,000 per month and your monthly debts are a car payment of $400, a student loan of $200, and credit cards of $100. That's $700 in debt. 700 divided by 6,000 equals about a 12% debt ratio. Then the bank adds what you might have for a future mortgage payment to that calculation to initially determine whether you qualify for a mortgage. Most lenders look at two different ratio numbers. First, they look at the front end ratio. Housing costs only, including mortgage, taxes, insurance, and HOA. Traditionally, banks like to see this at around 28% of your total monthly income. Then they look at the back end ratio. This includes everything like mortgage, car loans, student loans, credit cards, and personal loans. Historically, this guideline was 36%. However, today there are some lenders that are going 43% or even higher. Here's one of the first problems. Debt ratios are based on gross income. Obviously, that means before taxes. So if you're grossing $6,000 a month, you might only bring home about $4,200. But the bank still calculates your mortgage based on the $6,000. That's a big difference. Debt ratios only count debt. They don't look at things like utilities, groceries, gas, maintenance, insurance, or daycare, or the fact that some houses are just simply more expensive to own. So two families with the same exact debt ratio could have very different financial realities. Debt ratios started as guidelines, but today in some cases, they're often treated like hard limit hurdles with very little nuance. Modern mortgage approvals are heavily driven by automated underwriting systems. If the system says the ratio is too high, then the answer is simply no. In my opinion, when it comes to debt ratios, this is the single most important thing that you need to know. Once your mortgage is approved, do not change your financial picture, period, hard stop. Between approval and closing, lenders will often recheck your credit, verify your employment, and take another look at your bank statements. Here's the deal. If your debt ratio changes, your mortgage can disappear. No closing, no new home, all your hopes and dreams shattered. And people unknowingly do this kind of thing all the time. They run out and they buy furniture. They get cars, electronics, or appliances on either credit cards or on one of those easy payment plans through the store because they're excited about their new house. They're excited to start their new life. But the resulting, say, $350 a month payment, that could push you over the debt ratio limit. And guess what? Deal over. Look, debt ratios are useful, but they're not a perfect measure of affordability. They ignore real life expenses that occur every day, every month, every year. They assume that everyone's financial situation looks about the same. And homebuyers need to learn to police this themselves and use common sense. Here's the big takeaway. Home strategists don't ask, what will the bank approve? They ask, what can I comfortably afford? Thanks for checking out The Home Strategist. If you appreciated this content, give us a like, drop us a comment, and please subscribe to the channel.